This is Matthew Cratter from Trader University, and today I want to talk about the everything bubble. This is part 3 of a series. I'd encourage you to watch the first 2 parts. This will make a lot more sense in that context. Otherwise, you'll still be able to get a lot out of this video. Part 1 was the Fed is in trouble, bond yields, which I'll link to below, as well as part 2, the dangers of US dollar debt, which I'll link to as well below. If you watch these 3 videos in a row, share them with your friends, you and your friends will understand the current economic and stock market environment better than 99% of all people out there. And this will give you a huge advantage when you're investing your own money or trying to understand what's happening in the years to come. I get a lot of comments in my YouTube channel and elsewhere. Stock market is a bubble, blah, blah, blah. Bitcoin is a bubble, blah, blah, blah. And people saying, well, I was around in 2000 and I watched my stocks fall 80% and it's about to happen again. I get these comments all the time, and I lived through this as well. I lived through the 2000-2002 bear market and the 2008 to 2009 bear market. I know what these were like. I know what they felt like, and I know how people reacted to them. The current situation and the current setup is completely different. And anyone who's trying to rhyme the current setup with 2008 and 2000 bear markets is going to be very confused and is going to be waiting for a crash that never comes. We get a lot of talk like, well, all the speculation in GameStop and the Wall Street bets and Robinhood traders, etc. This is a sign of a frothy market, which means that the market's going to crash. I agree we have a very frothy market. There really is an everything bubble. But to spoiler alert, it is not going to crash. And that's one of the things I'm going to be talking about in this video. We could compare this to an analogous period, not completely analogous, but during the Weimar Republic between World War I and World War II, shortly before Hitler came to power, you had this terrible bout of hyperinflation in Weimar. And as part of this, you had quite a bit of speculation. This is taken from the book When Money Dies, which is really an excellent book. It talks about how everyone was speculating in the stock market and in the real estate market in the early 20s, and they all thought that they were making a ton of money, when in fact what was happening was the currency was failing. Stocks started off with a 20% dividend yield, which makes sense because Germany was quite destroyed during World War I. The asset prices fell a lot, and so dividend yields were quite high. But in response to all this money printing, stocks went up so much that that dividend yield of 20% went all the way down to 1%. So you had something very similar happening in terms of speculation among the general population. This says that people from all classes and all backgrounds were playing in the Weimar Germany stock market. Now let's talk about the current bubble that we're seeing right now. We can see the S&P 500 is basically gone straight up with a couple blips, for example, from COVID, but it's basically gone straight up from 2009. Same for the NASDAQ, the QQQs. Bitcoin obviously has gone from 5,000 to almost 60,000 in a relatively short period of time. Treasuries, I'm looking here at the yield. The yields peaked in 1980 at around 14% on the 10-year note and have fallen. Basically, they almost fell to zero last year, got very close, and now have slightly rebounded to 1.6, 1.7%. So we can see because prices move inversely with yields, there's also this huge treasury government bond bubble as well. If we turn to the real estate market, it doesn't look any different. Los Angeles real estate prices straight up since 2012. Same for Seattle, same for Denver. I could go through and look at every market, and you would see this across most markets in the U.S. and probably worldwide as well, especially in Asia and Europe. If we take a look at the PE for the S&P 500, and this is where a lot of value investors and stock market bears get their ammo from, the 12-month trailing PE ratio for the S&P 500 has gone really straight up since late 2011. It was trading, the S&P was trading at a really reasonable PE of about 13, and now has moved as of as of the end of last year, has moved up to 38, and it's actually probably closer to 40 right now. So prices have moved up, valuations have moved up, and one of the main reasons that stock prices have moved up is because we've had multiple expansion. The PEs have moved up. Earnings have also grown for many stocks. For the stock market as a whole, I think what we've seen more is an expansion in the multiple that's applied to those earnings. Now, I've been seeing a lot of articles, and this is what drove me to make this video, a lot of articles in the Wall Street Journal, for example, about how investors are just being dumb. They're overpaying for stocks. The stock market's overvalued, and because it's overvalued, it's going to crash something like 50 to 90%, and you haven't seen a real bear market until you've lost 90% of your money. From 2000 to 2002, many of the large internet stocks, I believe Amazon fell 85, 90%. So you had major companies that would go on and do really well, go down quite a bit. I would say the S&P went down about 50% from 2000 to 2002, and roughly 50% again from 2007 to the bottom in March of 2009. Now, before I go on, I'd ask you, if you're finding this video helpful, to please hit that subscribe and like button, and maybe also share the video with a couple friends after you've watched it. So we've established so far that there is a stock market bubble. It looks like there's a Bitcoin bubble. Looks like there's a real estate bubble, and people have duly noted all of the froth in the market, and that's where we get all these editorials from. But I would suggest that these op-eds are using the incorrect historical analogy or the incorrect historical rhyme. The U.S. economy, the U.S. political situation is in a far worse place than it was in either 2000 or 2007. In 2000, at the end of Clinton's second term, we were actually running budget surpluses. A lot of this just had to do with capital gains taxes being, tax receipts being very, very high because people were making a lot of money in the stock market. But the government was actually taking in more revenue from taxes than it was spending. So we had one of the rare times in history when there was a budget surplus. Interest rates were also much higher at that point. They were at around 6% at the market peak in 2000, which gave the central bank, the Federal Reserve, a lot more ammunition to actually fight the downturn. And when you are running, when the basic fiscal health of the government is good, and and interest rates are much higher, it gives a lot more fiscal and monetary flexibility. The government fiscal situation wasn't that bad either in 2007, though the banking system was about to explode, simply because there were too many assets on bank balance sheets given the equity capital. They were highly leveraged, and most of that exposure came from the U.S. housing market, which itself was clearly in a bubble. Housing prices had departed so far above income growth or average income. So this is what happened in the early noughts. The housing market was inflated and used as a way to help the economy and to repair the damage that had been done by the bursting of the stock market bubble from 2000 to 2002. So stock market bubble pops. Fed consciously engineers a housing market bubble to reflate everything. This was Greenspan's plan. Housing market then reached a bubble which subsequently popped beginning in 2007. Really didn't hit the stock market until 2008. Bear Stearns went bankrupt in early 2008, or had to be bailed out and bought. So the stock market bubble turned into the housing market bubble. The housing market bubble popped and basically bankrupted every single bank in the U.S. The entire banking system was insolvent and was then had to be bailed out by coordinated actions between the U.S. Treasury and the Federal Reserve. So stock market bubble led into housing market bubble, and then all of the toxic waste was moved to the sovereign or country level. The U.S. is functionally bankrupt. It has been for a very long period of time, just as anyone who makes giant promises about the future that they cannot fulfill in terms of entitlement spending, Social Security, Medicare. If you make these promises and your future liabilities are much higher than your assets are ever going to be, you are essentially bankrupt. Now, it helps that the U.S. is the world's superpower and has the world's global reserve currency, because this allows the U.S. government and the Federal Reserve to play games and to try to smooth things around the edges. The problem is the chickens are coming home to roost. The boomers are starting to retire en masse, and the entitlement promises that were made to them and subsequent generations can never be paid off without resorting to massive money printing and currency devaluation. This is why we're at a very different point in U.S. economic history than we were when the boomers were much younger in 2000 and 2007. In addition, as part of bailing out the U.S. banking system, the U.S. government's debt, Treasury debt, has risen in a very large way. And the combination of sort of off-balance sheet debt, the entitlement promises plus Treasuries on balance sheet debt, means that interest rates can never significantly rise again. The debt situation is much, much worse now than it was in 2000. And rather than having budget surpluses, we have giant deficits, giant budget deficit spending. And this is regardless of whether there's a Republican in the Oval Office or a Democrat. These are things that transcend party lines. And this deficit spending is just a symptom of where we are in the fall of the current world reserve currency. And so the fact that there's a lot of government debt, this huge amount of government debt, means that interest rates can never significantly rise again. The Federal Reserve, which is the U.S. central bank, needs to control rates, needs to control interest rates and yields and make sure they don't rise again. And the way that the Fed does this is it prints up money and it buys treasuries and it buys corporate bonds and junk bonds and tries to keep those yields low and try to keep everything under control. But the real escape valve there is the currency, as they print and summon all of these new dollars into existence. So what's happened over the last 21 years? The bubble has moved from the stock market to the housing market, to the banking system, to the very balance sheet of the federal government and the Federal Reserve. There's literally no way out besides printing money and doing all of these bailouts, and in addition devaluing the currency and paying off future spending promises with devalued dollars. The only other alternative would be to default on U.S. debt, just not to stop making the interest payments or not pay back principal, default on retirement promises to boomers. You cannot do this. It would cause a global, defaulting on U.S. debt would cause a giant global financial crisis, and it would ultimately not really solve anything. And you certainly can't not pay retirement promises to people who are depending on it, who may be depending on those payments for food and shelter, etc. And so in addition to just sort of the human toll, it would be way too deflationary to go this route of what people call fiscal austerity. If you owe too much money, you just don't pay people. Well, it destroys your credit forever. It destroys your life. You don't have to pay back the money, but it might be worse than the inflationary road. And so there's literally no way out. We're not going to go down this route of fiscal austerity. People have become very complacent and used to things being very, very easy. We're very different kind of people than the people who endured World War I and World War II. I think we're much softer, not just Americans, but globally in most parts of the world, I would say. So there is an everything bubble. This is not 2000 or 2007, those previous stock market bubble peaks. Something has fundamentally changed. Fundamentals, as I've been arguing for a while, PE ratios, earnings, free cash flow, rental yields do not matter on the margin anymore. They still matter, obviously, if you're a company with high growth and good future earnings prospects, you'll trade at a higher PE, etc. But when you look at the fundamentals of stock indices and asset classes, these fundamental things do not matter anymore. The only thing that matters, or that matters on the margin, the real driver, is Federal Reserve policy and money printing. And this is why there's so much tea leaf reading surrounding whenever the Federal Reserve and the FOMC has an announcement or releases their minutes or their latest decision on interest rates, because this is the most important thing for the stock market and for the real estate market. This is the new fundamental. And there is indeed a bubble, not only in real estate and stocks, but in U.S. Treasuries, other sovereign debt, the government debt of other countries. So this is a problem in Europe. It's a problem in Japan. It's a problem in the UK. It's really a problem in all developed countries where there is a lot of government, a lot of central bank buying of government debt, which is also, you may have heard the term quantitative easing going on. And this is simply because there are no new marginal buyers for this debt. And so the central banks need to step in and take down the supply. Now, because U.S. Treasuries and government bonds are mispriced, this means that all the other assets which take their cue from, for example, the 10-year note interest rate, which is the sort of the benchmark or the North Star against which mortgage rates and car loans, etc., are measured, as well as obviously Fed funds and other points of the yield curve. But basically, interest rates are lower than they should be, and there's all the central bank interference. As a result, all the other asset prices are mispriced. When interest rates get really low, asset prices can get really high. And one way to think about this, if, for example, a few years ago, you used to be able to get, call it 3% in your savings account, and if you can't get that anymore, if your interest rate has really gone to zero in your bank savings account or high yield savings account, maybe then you go and you buy some dividend stocks instead and try to get an average 3% dividend yield to sort of make up for that shortfall, which you might need. You might need that quarterly cash flow in retirement. But in the process of buying those dividend stocks, you push up the stock market. I'm just trying to show how low interest rates trickle across other asset classes and inflate them as well. If you're used to investing just in bonds and you can't get 3% on U.S. Treasuries, as I said, at the peaks in 2000 and 2007, the stock market peaks, you could still get T-bills, which are the really short-term treasuries, and you could make 5 or 6% annual yield on them. 3% a few years ago, you can make maybe on the 10-year note. If you are a bond investor or a treasury investor and you can't get these interest rates anymore, maybe you're pushed out the risk curve. So you buy corporate bonds, company bonds instead, or even junk bonds, which are much higher risk corporate bonds. And what this does is it drives down the yield on all this corporate debt. It allows these companies to borrow at lower interest rates. Now, what do these companies do then? If they can issue debt at very low interest rates, they do that as much as they can. This has really been happening over the past decade. And then they use the proceeds to buy back their stock, in the process leveraging up the company, taking on a lot more debt, and raising the stock price. Now, if you're a CEO and you want to be very conservative and you don't want to lever up your company balance sheet by issuing a lot of debt and buying back the stock, if you don't do this and you're actually the only sane person in the room, you're still in trouble because all your competitors are going to be doing it. Their stocks are going to be outperforming. They're going to make you look bad, and you will probably lose your job as CEO. And so in the process, these low interest rates get transmitted to the stock market and result in much higher stock market valuations. The same goes obviously for mortgage rates. When interest rates are low for mortgages, you can borrow a lot more money for the same fixed income or the same fixed annual income. You can borrow more money because the interest rate is lower, and so you can pay up for a house. Housing prices go up as well. And then you also have the situation of really wealthy people who no longer need their capital for living. They have enough money to live on, and so they take the surplus and they just put it into the stock market and the real estate market as a hedge against inflation, loss of purchasing power, and Fed money printing. These are people who are buying stocks and real estate not because they need them. No one needs their 10th house, but as a hedge against their wealth losing its purchasing power. Here's a great example of, at least until recently, a lot of the apartments and housing in Manhattan, for example, or any major city, are owned by really wealthy people who never actually even visit. They're just parking their capital here. So this article is pretty funny. It talks about what it's like to live next door to an oligarch in, I believe, in Vancouver, and the person is never there. Now, if we take a look at the Fed's balance sheet, this is another way of showing how different things are than they used to be. Back in 2000, the Fed's balance sheet was below $1 trillion. These are mostly treasuries and mortgage-backed securities that the Fed buys with newly printed dollars. So we were below $1 trillion. The Fed's balance sheet was below $1 trillion back in 2000. In 2009, it began to rise, but really only hit around $2 trillion. So still a big percentage move, but relatively low. And before the great financial crisis in 2008, the balance sheet hadn't risen very much. It was still under $1 trillion. Now we're closing in very quickly on an $8 trillion balance sheet. Most of this growth has happened, we can see, since March of 2020, and obviously the pandemic and the lockdown and all the knock-on effects of that. But this is what's very different. When you have a stock market bubble, when the Fed is not doing quantitative easing or is doing very little of it, it's very different when everything is being driven by stock market, by Federal Reserve money printing, as it is now. So it really is different this time. People like to joke and make fun of people who say it's different this time, but sometimes it really is different. For example, when the internet was invented, things really were different. When the iPhone was invented, things really did change. Right now, I would suggest that we're in the middle of a slow motion currency crisis. It's slow motion, and so we don't always see the effects happening, though we certainly saw them back in March of 2020. But this is the unraveling of the current financial system, the current global fiat currency system. And we're right at the beginning right now of the end game. As I said, all these central banks, from the Fed to the ECB, the Bank of Japan, BOJ, everyone printing money and buying government bonds. The U.S. has taken advantage of its status as a world reserve currency to rack up massive debts. And as we said, the U.S. will never be able to pay off this debt through higher taxes or GDP growth. You could confiscate 100% of the wealth of all the billionaires in the U.S., and it would still be just a drop in the bucket in terms of the future liabilities that are attached to the U.S. government. The only way out, because you can't do fiscal austerity, the only way out is the inflationary route of devaluing the currency and paying off the debt with devalued dollars. So this is what's been happening and what is going to happen. The Fed is going to keep interest rates below the rate of inflation for at least the next decade and probably forever. So they're currently targeting 2% average inflation. The 10-year Treasury note has a yield of about 1.7%. So the yield you're earning is less than the inflation rate. And this is very bad for bondholders, but very good for the government that issued those bonds, because it means that the purchasing power is gradually being eroded and they'll be able to pay it off using those devalued dollars. So what's going to happen over this next decade? If you're holding a lot of cash over long periods of time, if you're holding treasuries or low-yielding bonds like government bonds, like treasuries, you're going to lose a lot of your purchasing power. This is not the time in the cycle to try to hide in cash. Obviously, you should have whatever people say, call it 3 months of liquid cash to meet your expenses. We're not talking about being 100% invested and then not having any money if the stock market pulls back. But we're talking about if you have a very large allocation to cash or bonds over the coming decade, you are going to get hurt and you will be less wealthy after 10 years than you were at the beginning. And this defeats the whole purpose of investing. When we invest, we forego current consumption in exchange for hopefully future consumption and an increase in purchasing power. But if you hold your money in bonds that are yielding less than the inflation rate, you're actually losing purchasing power. It's okay to do it for a couple months. Maybe you're buying a house or something, so you want to hold some cash. That's completely different. But we're talking about a large multi-year or decade allocation to cash and low-yielding bonds is, in my opinion, a really stupid move. Stocks are going to do really, really well. They're going to continue to do really well, not because the economy is any good, but because the currency is failing. Now, this sounds crazy, and I can hear at this point a lot of people saying, well, show me a country that's in really bad economic shape whose stock market has gone up a lot. That just can't happen, because we all know that the stock market is a reflection of the economy. Well, people who invest in emerging markets know that this is simply not true. If we can take a look at the Zimbabwe stock market, it is up. If you think you've done well in 2021, Zimbabwe stock market is up over 1,000% in just the first 3 months of 2021. And we can see that it's gone since last year, really since November of last year, it's gone from 1,000 to almost 9,000. So it's up eightfold. And obviously Zimbabwe is a country in a lot of trouble. It's a very dangerous place. The rule of law is not what we would hope it would be. And so here's an example of a country in really terrible shape whose stock market has done really well. Now, the rub here is that the currency has fallen more than the stock market has gone up. So it looks like you're making a lot of money on paper, but the Zimbabwe dollar, or whatever they call it now, has gone down by more than the stock market has gone up. So you're actually still losing money, but the nominal growth in your stock returns looks really spectacular. Likewise, we can pick another fairly troubled country, Venezuela, up 100% since the beginning of 2021. And we can see that it's really gone up a tremendous amount over the last year as well. So these are examples of countries whose stock markets are doing really well, at least at face value, simply because the currencies are falling so quickly. Now, you don't want to invest in Venezuela or Zimbabwe because the value of the currency goes down by more than the stock market goes up. But if you're not thinking in terms of currencies, if you're just looking at your quarterly returns from Fidelity or Vanguard, you're missing this fact. And Ray Dalio just pointed this out in a great tweet. Most worry about whether their assets are going up or down in value. They rarely worry about whether their currency is going up or down. Most people don't pay enough attention to their currency risks. And especially if you're used to holding US dollars, you may have been lulled into a sense of complacency, because we're lucky the US dollar has lost a lot of purchasing power over the last 50 years, but it's nothing like Zimbabwe or Venezuela or Argentina or Brazil or one of these countries. And not to single those countries out, because there's certainly a lot of other countries in that basket. So what do we have here? We do have an everything bubble, but this is not a bubble that is going to pop. The everything bubble will not pop, especially when you look at it denominated in US dollars. Instead, stocks, real estate, housing prices, and Bitcoin will go up massively this decade, probably in all currencies, certainly in denominated in US dollars. We will not see another deep bear market in stocks or real estate, as we saw in the real estate bubble popping in 2007 to 2009, or the stock market crashes of 2000, 2002, and 2008 and 2009. We will not see a deep bear market where stocks go down 50%. I think we could obviously see a quick 20, maybe even 25% crash, something similar to what we saw last March when the pandemic hit, but it won't be long-lived, and the stock market will recover really quickly, as it did in March of 2020, simply because whenever the stock market crashes, the Fed is there to prop things up. I would say the one caveat or the one footnote here, obviously if something really, really bad happens, like there's a global nuclear war or a real pandemic that wipes out 25% of the world's population, something like this, in that sort of situation, especially the nuclear war situation, you could imagine stocks falling quite a bit. So ignoring those fat tails and black swans, just looking at the normal economic cycle, etc. Even bad things happening like the pandemic last year, hitting the stock market in February and March, it was a very short-lived crash. And if you went on vacation, you really didn't know anything had happened if you went on vacation for a couple of months and came back and checked your portfolio. So I'm suggesting that we will not see another deep bear market in our lifetime, at least in the next 10, 20, 30 years. This is why we have this expression, stocks or stonks only go up. And this is simply because the US dollar only goes down now because of the central bank money printing. The US dollar will keep going down, not necessarily versus other fiat currencies like the euro and yen. I'm a little bit more agnostic how those currencies move relative to each other. But all of these fiat currencies are sinking ships that are losing their purchasing power. US dollar has lost a lot of purchasing power over the last 50 years and will continue to lose purchasing power. And in the process, driving stocks up. And this is why you have the expression stonks only go up. It's a very naive, stupid thing to say, but I think at a deeper level, it's actually the correct way of looking at the market. I'm massively bullish on stocks, on real estate, and obviously Bitcoin, not because I'm naive, not because I haven't lived through bear markets, or I'm excessively optimistic, what you would call a Pollyanna, but because I understand that we are currently in the end game. As I said, if you stay in cash and safe bonds this decade, you're going to think that you're playing it safe, but you're going to get killed by a loss of purchasing power. And this is what Ray Dalio was talking about in the article that we talked about in yesterday's video, which I'll link to below. US dollar is in the process of losing its reserve currency status. All the world fiat currencies are in the process of being massively devalued versus real assets. And this is something that has happened historically. The Portuguese currency was the world reserve currency, followed by Spain and the Netherlands and France, and then, of course, the British pound up until right around World War II. And then the U.S. really has been, for most people who are alive now, their lifetimes, the U.S. dollar has been the global reserve currency. It used to be pegged to gold. It's no longer pegged to gold, and it has been devalued a lot since that peg was removed, or that redeemability was removed in 1971. So I think it's going to be a very messy decade. This is a once-in-a-century event that we're witnessing, the loss of global reserve currency status by a global reserve currency. And in the process of having these asset market bubbles that don't pop, you get a lot more wealth inequality simply because the upper 50% who own stocks and real estate do really well versus the lower 50% who don't own any stocks and are renting. Their rents go up. They do not, they fall further and further behind simply because Fed money printing inflates assets. And if you don't own assets, you get poorer and poorer relative to people who do own real assets like real estate, Bitcoin, and stocks. As a result of this increasing wealth inequality, we'll see more of what we've really seen over the last year or two, a lot more class warfare, racial tensions, increasing political polarization, and you'll see Republicans and Democrats fighting with each other. The one thing that they'll be fighting about many social issues and justice issues and economic issues, of course, missing the really important thing that the central bankers are behind this mess more than anything else. And it's one thing you'll never hear Republicans trash or Democrats trash, these central bankers and the Federal Reserve. We had Ron Paul going after the Fed a little bit, but we're still at the point where people don't even realize what's happening and what's causing this wealth inequality, what's causing all the political polarization. In addition, we're going to see increased government control of the economy. We've already seen that. As they say, never let a crisis go to waste. Use every crisis to expand your power and try to control people's lives more and more. We're going to see higher taxes, unfortunately, possibly even capital controls. If you're trying to destroy, devalue your currency, you don't want there to be any escape valves for people. And so regulators will force insurance companies and pensions and endowments to own these treasuries, which are terrible investments for anyone else, but they'll be forced to hold them on their balance sheet. And we may reach the point where the government tries to stop movement into, I don't think they need to stop movement into gold, because the gold market has really been destroyed by the paper gold market over the past 50 years. Gold has not been responding to money printing, but we may see attempts at capital controls into something like Bitcoin. It'll be much more difficult to control capital flows into stocks, so I'm not sure how exactly they would do this. The other thing that's really happening at the The geopolitical level is as the U.S. loses its currency reserves, global reserve status, it looks like the yuan renminbi is gaining and may be the replacement. Maybe Bitcoin will be the replacement, but maybe China will continue to grow. So we risk there obviously these tensions will increase. There's a good chance that we enter into maybe a Cold War with China. Maybe we're already there. Some sort of we're already at the point of real financial competition, and we have U.S. government bonds and Chinese government bonds competing for capital, but we could reach the point where it escalates to a cyber war or, heaven forbid, something more of a hot war than that. In addition to revolutions in less stable countries, if the U.S. is going to have all this political instability, you can imagine what's going to happen to countries that don't have the same history of rule of law and order, possibly a civil war as well in the U.S. Now, Bitcoin, I've said that asset prices are going to continue to go up. I continue to believe that Bitcoin is going to go up more than anything. It is the scarcest asset out there. There are only 21 million coins. Many of those are locked up forever by hodlers or have been lost. And so there are actually many, many fewer than 21 million coins. And Bitcoin will be an excellent way of hiding from government capital controls. If things get really bad in your country, you can just hop on a plane with $100 million worth of Bitcoin stored in your brain, in a brain wallet, just your seed recovery phrase. You cannot hop on a plane or a boat with $100 million worth of gold. It'd probably sink any normal size boat. And of course, you're going to be searched at borders, etc. And so Bitcoin, in addition to being scarce and also an excellent store of value, is going to be a very nice way of evading government capital controls or possibly even massive tax increases. Now, I'm not suggesting you do anything illegal, but just in general, not talking about the U.S. specifically, but in general around the world, Bitcoin is a very nice thing to own in this environment of financial repression and currency devaluation. And so if you've been watching my channel for a while and you don't own any Bitcoin today, I don't know what to say. I've gone through this so many times, but here's just another take on it. You can also own stocks as well, obviously, but Bitcoin is the best life raft that's available, and there are only so many seats available on that life raft. If you're sitting 100% in cash because you think the stock market's going to crash, or you're waiting for a big Bitcoin pullback because you think they're both in bubbles and you want to get in on a big pullback, I don't think you're going to see very big pullbacks. Obviously, Bitcoin can go down 10% anytime it wants. It's very volatile, and likewise with stocks. But if you're really waiting for that big bear market like 2000 or 2008, I don't think you're going to see it. I think if you're staying in cash, you will be waiting forever because you will not see this typical pattern. The everything bubble is here, but the everything bubble is not going to pop. Instead, the currency is going to continue to go down, and thus every asset that's denominated in that currency will continue to go up in price. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching. I know this was a long one. Hope to see you in the next video.